In 1789, Benjamin Franklin coined the now very famous phrase, nothing is certain in life except death and taxes, meaning that it's inevitable that everyone is going to eventually die. It's also inevitable in most societies that we are going to be required to pay taxes. In this video, I'm not going to talk about death, but I'm going to talk about taxes, and specifically about the taxes in Medicare and Social Security that you'll be required to pay in 2025. All right, I want to begin by talking about the taxes that we have to pay for eventually receiving Social Security benefits, or that Social Security income check on a monthly basis. All of us, as we work, we are funding Social Security. And so the way this works is if you're working for someone who is your employee-employer relationship, you are paying FICA taxes. That's the Federal Insurance Contribution Act. If you're self-employed, it's called the Self-Employment Contribution Act. And so all of us are paying money into this system so that eventually we'll be able to draw those benefits from Social Security. And so right now, in the present system, you're paying taxes equal to 6.20% for Social Security. And if you're working for someone, that employer is actually matching that amount as well. Okay, and then what happens if you're self-employed? Pretty obvious, you're going to have to pay that full 12.40%. That would be under that particular act. And so what happens is we're working and they're taking this percentage out of our paycheck, they're matching that, but there's always a limit as to how much income is going to be subject to Social Security taxes. And that's actually called the max tax. And I'm going to show you a chart because this max tax, of course, has changed throughout the years. Since the inception of Social Security, which the law passed in 1935, by 1937, they actually were issuing checks and making deductions. So in the beginning, the max tax was $3,000, and that was it. So whatever income you had up to $3,000 would have been subject to the tax rate at that particular time. And then you'll notice, so we'll jump ahead here, about 35 years, and it's jumped up just $9,000. And here's why. Because the increases between 1937 and 1972 were ad hoc. They were just impromptu. It was just as Congress deemed it necessary to raise that amount. All right, there was no legislation really dictating that. It was just something they would make a decision based upon what they felt like was needful. All right, so that's what happened for 35 years. And then in 1972, legislation was passed to actually tie these increases to the National Average Wage Index. In other words, they want it tied to something so it would no longer be ad hoc, but would be something that would be a formula that they can actually count on. And so by 1975, because of the changes in the way increases come, no longer ad hoc, now it's up to 14.1. And then we jump forward 20 years, 1995, that max tax was 61.2. So meaning if someone made above the 61.2, that income was no longer subject to Social Security taxes. 2015, 118.5, and today it's 176.1. That is the new number again for 2025. So all your income that is earned income that's subject to Social Security taxes up to that point in time, again, you're paying 6.20%, employer matches it, or you pay the full amount if indeed you're self-employed. So my point is, if we get above that number, now zero of that income is going to be subject to taxes in 2025. All right, so that's taxes for our Social Security income benefits to eventually receive those. Now I'm going to talk about actually the taxes on Social Security income. So not only are we paying taxes to draw that benefit eventually, but we also, once we begin to draw Social Security, we're also going to be subject to paying income taxes on those Social Security benefits. Now everyone does, but there's actually a formula that we follow for this as well. So what I'm going to do is break this down federally as well as state income taxes. So for federal, the federal income tax is structured based upon this right here. Let me just show you this. So here's the way it works. From 1937 to 1983, so what was that, about 46 years, there were no federal taxes that were due and payable on our Social Security income. But then in 1983, this was under the Reagan administration, they changed that rule, as well as that rule that was just repealed recently and overturned, which was called the windfall elimination provision, or the government pension offset, which affected people that had pension income by non-covered Social Security. And that law started back in 1983, and that was just repealed effective January of this year of 2025. But my whole point is, Up until that point in time, no taxes. Then, with that legislation, then things changed. And so what happened, for 10 years, they had a formula that they followed, and then they changed that as well. So I'm going to go through and talk about how we would calculate today how much of our Social Security income will be subject to tax. No one is going to be subject to 100% of their Social Security taxable, but it could be up to 85%. So let me show you how this works. So what we do is we call this provisional income. Also want to note this, some people call this combined income. Both, they're synonymous terms. And so the formula for provisional income, which determines how much of our Social Security will be subject to income taxes federally, would be this. What we do is we take our adjusted gross income, which is really all sources of your income, and that is on line 11 of the tax return, 1040, line 11, adjusted gross income, plus any tax-exempt interest or non-taxable interest. This is tax-exempt interest. And this, by the way, is line 11. This over here is line 2A. So they add these two numbers together. Let me explain tax-exempt interest. This is typically municipal bonds. People invest in municipal bonds, and there's no federal taxes due on the interest gained from those bonds. Sometimes savings bonds have this as well. So a lot of people don't even have anything on line 2A because that's not part of their investment portfolio. But if it is, you would have something on line 2A. All right, so we're building the formula to determine our provisional income. We got AGI plus tax-exempt interest plus 50% of our Social Security benefits, okay? And so if I'm making $24,000 a year in Social Security benefits, then that would be $12,000 added to my AGI and my tax-exempt interest. And that number is going to equal our provisional income. So it's a very important number, also remember, called combined income. So what happened then for 1983 to 1993, this was the formula. Again, we have single filers, we have married that file a joint return, not separate, but a joint return. Here's the numbers. So if I am at $25,000 or below as a single filer in my provisional income formula, if this equals $25,000 or less, then zero of my Social Security income is going to be subject to taxes. Zero. Okay, now above this, what would happen during these 10 years here, if I was above the number, then 50% of my Social Security was going to be subject to income taxes. So that's the most. So 50% exempt, 50% I'd be responsible if I'm a single filer above this. Now, over here from a married filing a joint return, this number was $32,000. Or below, again, zero of that is going to be taxable. And then for 10 years, anything up here that would be above it, then 50% of that would be reported on my federal return as taxable income because of Social Security. All right, so that's the way it was for 1983, 1993, so for 10 years. Well, then here's what happened. In 1993, now to the present, today, 2025, they changed the system. They increased this. So then they established a new number. So what they did is they said if you're single and you are at $32,000 or below, you're in this range here, again, they kept that at 50%. But if you're above $32K and your provisional income, now 85% of that income that you're going to be now having to pay income taxes on 85% of your Social Security income. For a married couple, this number went to $44,000. So again, if I'm in this range, I'm still at 50%, but if I'm above that since 1993, now I'm going to have to report 85% of my Social Security income as subject to federal income taxes. All right? And so this is the system that we have in place. Now, what's interesting about this is this additional tax revenue that they created by raising the limit actually goes to Medicare Part A, the Hospital Insurance Trust Fund. They were trying to beef that up, and this is the way in which they did that. So my whole point is we've got to calculate our provisional income to determine where we fit in here. So if I'm below here, nothing has to be reported as taxable. If I'm in here, 50% of that amount is reported as taxable here, 85%. All right, so wherever that number was, below 25 or below the 32 for a married filing a joint return, what we're going to look at now is this line right here called Social Security Income Benefits. You're going to notice that we have a taxable amount right here, and we have an amount that's not taxable. All right, so that provisional income number, if I was, let's say I was single and I was between the 25 and the 32, then 50% of whatever I received for Social Security benefits would be reported on that line right there. And then it would be subject to whatever my federal tax bracket is. Today, that's anywhere from 10% to 37%. So if I am high income, and let's say I'm a married couple and I'm above the 44,000 threshold, then 85% of my Social Security income is going to be reported on that line. All right, so no one pays 100% on that line. It can be 0, it could be 50% of your Social Security or 85%, but whatever that is, then that will be applied to whatever your tax bracket is going to be. All right, so that's exactly the way it's going to work for taxes on that Social Security income. Hey, if you found this video helpful and you want to see more Medicare information just like it, then go below, right below the video, and you can give us a thumbs up as well as subscribe to our channel. And every time I put a new video, which is about 2 every week, you'll be notified of that video, and others just like you who need this vital information will get it as well. All right, so that takes care of the federal side. Let's very quickly just talk about then the state income taxes on our Social Security income. Now, what you're going to note here is that 41 states, 41, so almost all of them, all your Social Security income, no taxes for that state. Okay, when you file your state returns, they're not going to require that you report your Social Security income. However, there are actually 9 states that have different rules, and they're going to certainly vary state to state as to how they're going to handle your Social Security income as far as being subject to state income taxes. So I'm going to go through those just with you real quickly. And first one will be Colorado. So here's the way Colorado works. Those that are 65 and older can subtract the full amount of their Social Security benefits from their Colorado tax return. Starting in 2025, taxpayers between 55 and 64 that are receiving Social Security benefits, that would be disability and those who filed early, they can deduct all their Social Security benefits if their adjusted gross income is $75,000 or less as an individual, or $95,000 or less as a married filing a joint return. Okay, so again, a very good possibility you wouldn't have to pay any. If you're above those, then you would have to. Let's talk about the state of Connecticut. Connecticut also has set some different parameters. Taxpayers whose adjusted gross income is $75,000 or less as an individual, $100,000 or less as a joint filer or head of household, you can deduct 100% of your federally taxable Social Security income. If your income is above that, joint above 100, single above 75, then you'll pay no more than 25% of your benefits will be subject to taxes. All right, and so that's Connecticut. Now that brings us then to Minnesota. Now Minnesota, here's the way it works there. They have what they call the simplified method, which allows taxpayers to know what's reportable and not. And so in 2024, last year, if you're married that files a joint return, if you're below $105,380 or a single, and you're below $82,190, then you can subtract all your Social Security benefits. None of those are going to be taxable. If you're going to be above those amounts, then you could be subject to state income taxes in Minnesota. How about Montana? Another state there, and here's the way they do it. Those with incomes below $25,000 as a single filer, or below $32,000, just like the federal provisional income, will not be taxed on their Social Security. So if we're going to be above that, then that money could be subject to taxes. New Mexico, next state. New Mexico, here's the way they do it. Seniors with income below the following levels will not have to pay taxes on their Social Security. So again, they're setting thresholds. So in New Mexico, single filers that make below $100,000 a year, married filing a joint return, or surviving spouses or head of households, that's $150,000. Married filing a separate return at $75,000 or below. So again, they have much higher thresholds in the state of New Mexico. Okay, let's talk quickly about Rhode Island, how they handle this. If you've reached full retirement age and you receive Social Security benefits during the year, Rhode Island provides an exemption as long as your income is below the following levels. Single, married filing separately, or head of household, that level's $101,000 in Rhode Island or below. Pay no taxes on Social Security. Married filing a joint return, $126,250 and below, no taxes due in the state of Rhode Island. Then Utah. Here's the way Utah does this. Utah allows for a tax credit for Social Security benefits on adjusted gross income thresholds of $45,000 for single, $37,500 for married filing a separate return, or $75,000 for a married filing a joint return. So again, we stay below those, no taxes due on that Social Security income. And then the state of Vermont, almost done here, we have this. Vermont offers an exemption for taxpayers with low to middle income levels. Again, they're going to set their numbers. So the exemption applies in Vermont in full for a married filing a joint return or a civil union filing a joint return of $65,000 adjusted gross income or below. Again, you pay no income taxes in the state at all, and the income threshold for full exemption for looks like a single filer would be $50,000. All right, so that's that. And then the last one is going to be West Virginia. They've been changing theirs the last couple of years, but here's the way it works. In West Virginia, the process of phasing out taxes on Social Security benefits for the 2024 tax year, 35% of Social Security benefits included in adjusted gross income can be subtracted. So that was 2024. So those of you working on your tax returns now, that's what you would get, 35% exemption. In 2025, when you go to file your returns this year, 65% of that Social Security income will be exempt. And then beginning in 2026 thereafter, the 100% of your Social Security income will be exempt from state income taxes. All right, so I want to make sure you're clear. We have the federal rules and we have the state rules. All right, so that covers the Social Security taxes. Now let's talk about Medicare. Again, taxes for Medicare, same rules are going to apply here under the Federal Insurance Contribution Act, Self-Employment Contribution Act. What we're doing is through our employment, our wages, we're having payroll deductions, or we're paying into that system as self-employed people on a quarterly basis. But the point is, we are also funding Medicare. Now, I want to clarify something just real quickly. In order to draw benefits for Medicare or Social Security, we have to have 40 quarters that are paid into that system. All right. And so a quarter changes year to year, but this year in 2025, the quarter is $1,810. $1,810. So as long as I have W-2 income or net self-employment income of $1,810, I just picked up a quarter. Now, I can only get 4 quarters in a year, but I don't have to work all year to get the 4 quarters. I just have to make that amount of money times 4. And so that would be 2 and 3. So this year in 2025, as long as I make $7,240, then I picked up my 4 quarters for this year. So as long as I accumulate 10 years worth of work, 40 quarters, now I'm eligible to draw Medicare benefits as well as Social Security benefits. That's the way the system works. Now, let's talk specifically about our taxes for FICA for Medicare. So right now, here's the way it works. 1.45% of every dollar you make as an employee is going into Medicare, and 1.45% is what the employer is going to match. If you're self-employed, you pay the full 2.90%. Now, remember how Social Security had a max, a limit? Not so when it comes to Medicare taxes. We continue to pay our portion, 1.45 or the 2.90. But then here's what happens. If we reach a certain threshold, and again, this is going to be our modified adjusted gross income, as a single filer, and if we ever get to $200,000 or more, then no longer is that 2.90 going to be enough. Now they're going to add 0.90% to everything above 200,000. If I have married, that is filing a joint return, this number is $250,000. Okay, and so again, you're going to have to pay everything above that additional 0.90%. Now, what changes though is the employer, if you're working for someone, they don't have to match that. All right, they can actually just pay the 1.45. They'll have to keep doing that as well as you're going to have to keep doing that. But we see the limits. You're the one that's going to be responsible for that additional amount. All right, so 2.90%. Some of you high income, 3.8%. So that's the taxes we pay for getting our Medicare benefits eventually. Now I'm going to talk about taxes on Medicare. Now, when you say, well, I didn't realize Medicare was taxed. Well, anytime you're giving the government some money, it's a form of tax. So there's a couple ways this happens, actually, is through premiums, because we're going to have to pay for Medicare. Now, Medicare A, as long as you have 40 quarters, has a 0 premium. But Medicare B has a premium. The standard premium right now, minimum, is $185 a month. But there's an additional tax for people that are considered to be high income, and I'll show you the parameters for that here in the next slide. But these additional amounts are called IRMAs, and that stands for Income-Related Monthly Adjustment Amount. So people that are above certain thresholds, and so what happens if I'm a single filer and my modified adjusted gross income is $106,000 or below, I don't have an IRMA. But But if I'm above the 106 as a single filer, now I'm going to have an additional surcharge. If I'm married filing a joint return, that threshold this year is $212,000. So again, if I'm below that, I don't have an IRMA. But if I'm going to be above that, then I'm going to pay that additional charge, that additional amount for my Medicare Part B. All right, and so that's why I'm saying these are additional taxes that you're going to have to pay for your Medicare benefits. All right, so let's go through this chart real quickly to make sure you understand how the premiums work and these IRMAs, if indeed you're considered to be high income. All right, so first off, again, hopefully you may be looking at this on your phone, if your computer, hopefully you can see the numbers, but I'm just really just trying to teach the concept of the way this works. So what you're going to notice, as I taught earlier, if I'm at $106,000 or below, I have no IRMAs, okay? All I have to do is pay what they call the base premium. This is what about 85 to 90% of all people pay. They pay that 105. It's billed quarterly or it comes out of their Social Security check. All right, so they have no IRMA, they're below the threshold. But now we have 5 different brackets of people that are going to be above that IRMA. So you can see as the income goes up, we're going to have to pay more for our Part B premium. All right, so let me explain. So in this level here, so this would be anyone between 106 and 133 as a single filer, married filing a joint return, $266,000. So this range here, we have an additional surcharge, that's 74, that's added to the base premium, which then gives us a total Part B premium, base plus IRMA, of $259. Now, as I go through this, I want to draw your attention to something. This chart is for 2025, but notice they're actually looking back at 2023 tax returns. They always look back 2 years. So in 2025, they're looking at 2023 modified adjusted gross income. Now, may I remind you what that is? Line 11 plus line 2A equals modified adjusted gross income. So you can look on your tax return. So they look back 2 years. And these numbers are recalculated every year. Okay? And so here's the point. Some people are going to have IRMAs at that level. Next level, you can see the IRMA keeps going to go up. Now we got an IRMA of 185 added to the base premium. Now we're paying $370 for our Part B premium. Again, this is a tax. Higher income. Now I got an IRMA, $295 added to 185, total $480. Next level, got a $405 IRMA added to base, gives me a $590 for my total Part B premium. And then the highest level, again, this is very high income. They added $442, total premium for B is that. Now, if I have a Medicare Part B IRMA and I enroll into a drug plan, which 99% of all people are or should, they're also going to have a small IRMA on the drug side of the equation. All right, and so again, if I stay below the thresholds, I have no IRMA on the D. There's nothing extra. I just pay for my Part D plan. But again, as these income levels go up, what's happening? They're adding a IRMA to my drug plan, $14, $35, $57, and all the way up to $86. So as I take all my B IRMA and my D IRMA, you can see what's happening. So the highest IRMA would be an additional $6,330 a year, and the other lowest IRMA is going to be a little over $1,000. And by the way, if you're married and you're both on Medicare, each of you are going to have to pay this because, again, you file a married filing a joint return. All right, so these are additional taxes that are paid on Medicare. All right, let me conclude just with another very important tax consideration I think you need to know about. So first off, we're going to talk about this principle, really, and this covers all insurance. There's a general principle that goes like this. The higher the deductible that you have on your insurance, the what? Lower your premium. And this is the way on home and auto, this is the way on all kinds of insurance. And certainly when it comes to health insurance, this principle also applies because there are some people that would rather have a lower premium and they're willing to accept a higher deductible. So in the health insurance business, the way the government has allowed this to happen with some tax benefits, they actually have set up some plans for people to do this, to have high deductible health plans, but have lower premiums. And so we call these health savings accounts. These can be individual accounts, they can be family accounts, they can come through one that you set up on your own, or it could come through an employer as well. But these are called HSAs, or health savings accounts. Okay, so the health savings account have to be designed in a certain way. So let me explain the parameters that actually have someone that on a plan that qualifies for the HSA system. Okay, so the design of these. And so what we have single and then we have family HSA accounts. And so again, we have to have a high deductible, so the government sets these limits as to what the minimum deductible can be, because again, we're looking for higher. And so if I have a single HSA, that deductible on my plan has to be no lower than $1,650. Now, it can be much higher than that, and it usually is, but that's the lowest. And then for a family, we have to have at least $3,300 when it comes to our deductible. Again, most of those are going to be much higher than that as well. So again, they set those parameters. Now, when it comes to the max out of pocket, meaning when the employer or the individual has designed this particular plan, they say there's only so much money that you have to spend. Even though you have a low premium, there has to be a max. And so right now, in this year, 2025, that number is $9,200. That's the max out of pocket. And so once you've reached that, then you'd have 100% coverage by that insurance plan. A family, max out of pocket is $18,400. And so in order to qualify to have a high deductible health plan and attach to it a health savings account, we have to be within these perimeters, and then if so, we can make contributions to that plan. Hey, if you come to a place where you know you're going to have to make some Medicare decisions pretty soon, the best way to do that is to click up here in this right-hand corner, and you'll have an opportunity to be able to book a call with one of our Medicare guides. All the guides around here I have personally trained, and they truly are professional. They'll answer your questions, and they'll show you different Medicare options to make sure that you're confident in the decision that you make. All right, let's talk now about the benefits of having an HSA. First off, the benefit is you have tax-deductible contributions. Okay, you can put money in, and all that money is going to be pre-tax money. So that's one benefit. The second benefit is you actually have tax-deferred growth. Some of these accounts actually grow. They can be tied to different funds, different indexes. And if that is growing, that growth, like an IRA, is going to be able to grow with no taxes. Those will actually be deferred. And then also, we have tax-free withdrawals. So this is the beauty, really, of having an HSA. These are very tax-incentivized type plans. So here's the benefits. Now let's look at some more details. And that is, how do we fund an HSA? So here's what's going to happen. That money, of course, is going to go pre-tax. It can come right out of our check. We can put money in, the employer can as well, but it is pre-tax dollars. But they also are going to set a limit to this. There's only so much money that we can put into that. And so again, for a single account, this year in 2025, we can put $4,300 in the account. A family can actually contribute $8,500, and I think it's $50 this year. I'm pretty sure. Off the top of my head, I think that's right. It's either $8,500 or $8,550, but the point is, it's not quite doubled on the family account. Now, keep in mind, these also can be used as long as, like for a family, that'd be a married filing a joint return, or any other tax dependents can benefit from that HSA. Okay, now I want to clarify something as well. For people that are 55 and above, what happens is the government allows you, like they do on IRAs and things, to do a catch-up. And so you actually can put an extra $1,000 in here. Over here, it wouldn't be $2,000. You can also put an extra $1,000 here if one of you is above 55. So we can actually put in about $5,300 here if we're single, and here we could put in $9,550 if we have a family account and we're above 55. All right, so we've seen how HSAs are designed. We see their great tax benefits, of course, but also how we can fund them and the limits to the funding. So once we've accumulated those funds, the next question is, how then can we use this money that we've set aside? And this has to do with actually withdrawing the money from the HSAs. And so there's actually 3 different ways in which we can withdraw money from the HSA, and I'm going to teach you about those as well as the implications of those. The first way is to actually do a tax-free withdrawal from the HSA. And this would be based upon a qualified medical expense. Qualified medical expense. All right? Now, I'm going to read an article to you which gives, I think, a very good definition of what exactly a qualified medical expense is. All right, this article really defines and describes a qualified medical expense. So let me just kind of read it to you verbatim. It says this: according to the IRS, the term medical care for a qualified medical expense means anything used for the diagnosis, cure, mitigation, treatment, or prevention of disease, or for the purpose of affecting any structure or function of the body. And if it's primarily for medical care, then it will be qualified to buy with your tax-free HSA dollars. So it has to be this qualified medical expense. Listen to this. They give the example. In other words, get new sneakers, not covered. But get pain relieving foot circulator, that is covered. All right. As well as any transportation needed for medical care is a qualified medical expense. Just one more statement here. Qualified medical care expenses must be for, here we go, products or services designed to alleviate or prevent a condition or an illness. So any product or service billed by a doctor, hospital, urgent care, optometrist, chiropractor, dental clinic, except for cosmetic, including the copays you'd have to pay for those visits, are all qualified. Also qualified are prescription medications and products like contacts, hearing aids, and more. All right, but it has to be a qualified medical expense for it to be a tax-free withdrawal. Now, many of the HSAs would provide the ability to use a debit card from the account, or you can pay for it and then actually reimburse yourself. Okay, so this is primarily what these accounts are set up to do, is to pay for medical expenses. Now, keep this in mind. This HSA money can be used by you or a spouse or any tax dependent. So if you file for them and they're part of your tax as a dependent, then that money can be used for them as well. Okay, so that's the way it works. And so, of course, this is the primary way in which people use their HSAs. Now, the second way in which we withdraw from our HSA would be a taxable withdrawal. And with that, there could be a penalty. So come and explain what this would be about. The HSA money is your money. Primarily to use for, of course, medical expenses, and then this, of course, went in tax deductible and it came out tax-free as well. But in this situation, this is someone that doesn't use it for a qualified medical expense, but what they're going to do is they're going to use it for a boat. It's their money, they can certainly do that, but what happens if they draw that money out prior to 65 and use it on anything that would be a non-qualified medical expense, then what happens is, of course, that money is going to be taxable. It went in pre-tax and when used for medical, so you have to pay the taxes, whatever your tax rate is on that. And then there's going to be a 20% penalty, okay? 20% penalty. So anything prior to 65 that comes out of your HSA that wasn't qualified medical, pay the taxes plus pay the penalty. Okay, that's one way. Another way, last way, would be to do a withdrawal, again, going for not qualified medical expenses. So that comes out, and it's still going to be taxable, but no penalty. Why is that? Because any withdrawal from an HSA that is made after 65, that penalty is going to be eliminated. No matter what you use the money on, it just does not matter. You have to pay taxes only. Okay. All right. So those are really the benefits, the features, and I love HSAs. I think people that have those as an option should continue to contribute to them because there are, again, some wonderful tax advantages for having money in one of those type accounts.